Okay, welcome back to another interview. This time we have Leland here, and it's really nice to have you on here. And, can you just introduce yourself a little bit and talk about your background to the audience and sort of what you've been doing? And yeah.
Oh, well, my name is Leland Roach or Lee Roach, and I am a value investor that started out writing for Seeking Alpha quite a while ago. And eventually, as I wrote about smaller and smaller value companies, had to move over to Substack. And my Substack newsletter, The Value Road, kind of took off, and I was recently able to quit my job to write full time.
hmm And you've spoken about your manufacturing job and all of this. So how was that experience to you, and what made you now suddenly shift to Substack? Just for the audience out there.
Well, so I grew up right outside of Flint, in a small like farming community, and every person that I grew up with that didn't farm worked in some kind of industrial manufacturing plant. So that's just kind of what you do if you are around my area, my neck of the woods, unless it's an industry that feeds into that
Mm-hmm.
industry. So yeah, I was out of high school, just went on the factory floor, and eventually I got absolutely tired of doing that. The pay kind of sucks for how much you break
Yeah.
your back. And I just started kind of diving into books and reading up on investing. Started investing myself to maybe see if I could maybe build a little bit of a nest egg. And I got pretty good at it, and I started writing about it.
And how did sort of that experience, with the manufacturing and starting into the investing market, like how did you stumble into that part of sort of, investing into these smaller companies that are obscure? Like what was sort of the factors that are leading you to this interview, essentially, so to
Oh
speak?
yeah. So it was probably losing a lot of money. So,
We all have
uh,
that experience at first, I
yeah,
don't know
yeah.
any good investor who didn't have that experience. So
Yeah, so I really did like as much of my homework as I thought, and I invested conventionally in like mega cap stocks, the best that I thought I could, and I actually got like taken to the bank on that. I invested a lot in like clean energy, solar, wind stuff, battery technology, oil, during
mm,
uh right during that COVID crisis, and
yeah.
my oil stocks did great actually, but all of my other stocks did generally pretty poorly, and I had to take a step back and examine like what am I doing, and instead of attacking investment from how do I make the most money, it was how do I not lose money. And as
mm,
soon as I started approaching investing with that attitude, my actual total returns got better.
mm. And
So
I assume
nothing.
this, yeah, and I also assume this sort of happened because of sort of that 2022 to 2023 period that sort of had like a, let's call it a harder time for the average investor out there because the overall market took a beating.
Yeah. So I wait. Ask that question one more time. Sorry.
Yeah, so I assume that you sort of reshaped that strategy partly because of that sort of environment that shifted during that time, or at least that's my assumption. You may correct me if I'm wrong, but essentially because the market was weaker at that time, and you sort of once you experience these sort of cyclical times, right? It always a little bit reshapes your strategy, right?
Yeah, yeah. I mean, by the end of 2020, as I had bought into all of these stocks, and a lot of them did, pretty good right away, and then just totally crashed out as all these, small time investors came in and started buying up all these like little small tech
Mm,
stocks and whatnot. And really, at the end of 2020, I had to reevaluate my investment. I bought in to a lot of things specifically because of hype, specifically because I was watching videos of Jim Cramer and a bunch of people on CNBC like
yeah.
telling me what kind of stocks to pick, and yeah, so I knew at that point in time that I didn't quite have the my investment thesis that I had wanted, but it just expedited my need to get that just
Mm.
extremely as soon as I started losing some cash right there.
Mm. And sort of for the audience, like, can you give sort of just a broad overview of what type of companies you're interested? I know they're sort of smaller, but like, what characteristics overall are you interested in? Like, what's the usual thing you look at, your go to, so to speak?
Yeah, so the I would consider myself a like micro or nano cap value investor for the most part.
Mm.
I will invest in mega caps too, but the main thing that a company generally has to have for me to consider it an investment at all, for me to turn the page into that initial like 10K or 10Q, is it either has to have like a large net asset value that is generally much higher than the total market cap,
Hmm.
or have an enterprise value that is much lower than the market cap. Some kind of like huge divergence between value and the actual stock price. And generally, that happens after a large business downturn or something like that, when a company will actually get cheap. But that's the very first thing that I
Hmm.
kind of look for. A lot of that is going to be in industrial companies or companies that own a lot of land or hard assets. And yeah, so that's the very first thing that I look for. And then the other thing is predictable catalysts. So
Hmm.
land companies, they sell land. If a company has a huge debt payment coming up and they might not have cash to shore up to make that payment, and they have a ton of assets, they almost always sell assets. Companies don't file for bankruptcy intentionally, usually.
Yeah.
So,
Yeah.
but investors will think that they will. Investors will
Mhm.
just say, "Hey, this company's got $20 million, debt maturity coming up. They have $12 million in the bank, and that's all they need to see for them to, kind of get scared off." Stock price plunges. All of a sudden, an investment becomes this opportunity, and you can catch the upside from that. So,
Mhm.
running into a fire has made me a lot of money,
Mhm.
so to speak. I like
And you,
disasters.
yeah, I can tell. It's sort of the same with that one meme where you're like holding your coffee and around you it's like burning, right? That's sort of your mindset,
Yeah,
really.
yeah,
Yeah.
absolutely. I like a lot of times the thing that catches my eye on a stock is like, oh, this went down 42% this year.
Yeah.
Like, I'm going to dive in. I don't, companies that have this amazing 100%, 150% growth story over the course of a year, it's not that is not possible to have a repeatable situation like that.
Mm.
But the odds that that's going to happen 2, 3 years in a row is pretty slim. Where a company that's in the gutter, sometimes they have no place to go but up, especially if
Mhm.
there's some kind of an asset value behind them that makes them uh, very attractive to another company.
Mhm. And you also often highlight sort of that smaller, let's call them retail investors, right? They can find an edge in those nano cap and cap spaces. Like, why do you think that? What are some of the reasons for that? Is it because the institutionals might not be fully able to go into those, or is it because they are just generally like not being talked around as much, and it's just sort of you're looking through all the dirt to find something good, right?
Yeah, there's like a twofold, I think, advantage that I have to investing in small companies that other people that are by no means rich have. One is that if you own 10% of a company's stock, like, you have to have a seat at the board. You have to help run that
Mm.
company. You have to delegate resources and time for that. So if you're like this tiny 10 million, $15 million company, large funds, they can't, it's not that they couldn't touch you, but they would have to spend an enormous amount of resources for the
Mm.
potential return that that investment could generate. And most of the time, it's not worth it for them. So you don't have to compete on finding these kind of like hidden gems with a bunch
Mm.
of hedge funds with floors of people in New York that have more resources than you, that can walk down the block and have lunch with the guy that does finance for this company or that
Mm.
company. So there's a huge advantage in that. So a lot of these like a lot of Apple, Google, all that stuff, they had been so overpriced just because these large funds
Mm.
don't have anywhere to put their money. and so they dump them into these huge mega cap stocks, and their valuations relative to the actual value that they produce, I think, gets skewed quite a bit. And
Mm,
you just do not see that in these microcap spaces. The balance sheets and income statements are much more digestible. You don't have to
mm. You don't have tens of pages of just financial statements as we know it in these
right.
companies. Sometimes 200 pages, 300 pages, and half of them
Right.
is mostly useless
Yep,
information.
absolutely. Or like Pershing Square can't come in and be like the largest holder in something, and
Mm,
for reasons that are not related to the market, they just want to sell this huge position, and then all of a sudden that stock tanks. That didn't have anything to do with
yeah.
the market per se. And you can just totally avoid that by investing in companies that these larger funds can't touch at all. And like you were
Mm,
saying, one of the companies that I had originally invested in was like Monster, and they're a great
yeah.
company, but their like annual statement is it's like 800 pages long or something, I believe.
Jesus. Yeah.
So it's like, and I can't read a Lord of the Rings, trilogy, you know,
Yeah.
you know, 4 times a year because I'm one person.
Yeah.
So it gives you the opportunity to do
Mhm.
your homework,
And
and you
often for
can,
those people that really do work on the side, for most of the time it's really more of a time constraint when it comes to finding your own approach, and that's why it can be advantageous to be in these sorts of spaces, especially if you do want to put in the work, right? It's a lot of hours you have to put in. It's not
right.
easy, and you go through these times where you're like, Jesus, my portfolio is down 20-30% maybe, and I have to revamp because all of these things went wrong. So it's you have to have passion, and I can clearly see that you do, right? Otherwise you wouldn't be writing about it. But sort of coming to my question is, do you ever fear that at some point let's say you do pretty well, right, that you sort of get to a point where you eventually price yourself out of your best strategy because you focus really on the small, right? Do you think that can scale perhaps to, call them $300 million companies, 500 million? Like, how do you see that sort of?
Yeah, I can. So some of these weird situations that I've talked about
Mm,
obviously will not exist at 100, 300,
yeah.
4, $500 million market cap companies, but I think that I could probably scale this general investment philosophy up to probably $500 million companies. Um,
Mhm,
right now, honestly, with some of these valuations that we're seeing, some of these tech stock companies falling into, you are getting value investment valuations for like Adobe
mhm,
and PayPal,
mhm,
that I think are becoming really attractive. So, um, a lot of these scenarios exist almost always in tiny microcap spaces, but
mhm,
sometimes these strategies really do apply to larger companies. And in situations where they do, you can make a ton of money off of it the same way you can on smaller companies, in my opinion.
mhm. Yeah. And because you're sort of in that deep value space, which requires also a lot of patience, like, how do you distinguish between, okay, this stock uh, really has the potential and this one might not? Like, where do you draw sort of the lines? Like, what are things you look at and say, okay, this fits my parameters, but because of this and that, it's not. I rather don't put my money in and rather maybe wait or look for something else.
Every situation is kind of different on that, but I've gotten way better. I think at picking better opportunities. Um, initially I just would buy things that I thought were cheap, and now I will only generally buy something that is cheap with an easily foreseeable catalyst somewhere in the near
Mhm,
future. A lot of times with these small companies, uh when you look at Seeking Alpha, Yahoo Finance, CNBC, and you scroll to a company and you go to like the disclosure section and you're looking through the 8Ks,
mm,
sometimes those 8Ks and these tiny companies don't like generate on those pages. And I don't know why. I don't I don't program websites. I'm not a software developer, but they don't. So a lot of times you can just read this stuff in an
yeah.
8K and know that a business turnaround is essentially happening, or on their press release saying that they're going to have an earnings call or whatever.
Mhm,
And the stock won't make a move because everybody trades so algorithmically nowadays until that information, that data is populated on all these sites. So sometimes it's just that I'm clicking on, I'm just reading a couple paragraphs on a press release, and it just gives
Mm,
me all this information I need to know. And because I'm going on this company's actual website to get it, or the OTC markets, it's just like an advantage, and people just don't do that. People like all their information stacked neatly into
mhm.
this single space, whether that be Seeking Alpha or their Charles Schwab or TD America account or whatever it is. But yeah, man, if you just like try to find the information at the original source that that information's available at, uh that's the best place to get it. I mean,
Mhm.
and a lot of times that data doesn't kind of raise up into these other websites,
Yeah,
or
and
there's a delay to it.
mhm. And it sounds like you also shifted from your strategy, right? At first, it was mainly value, but now you look at value with a catalyst. Like what brought you sort of to have maybe that change in mindset, and also, do you have perhaps a limit on sort of a time limit on your thesis? Because having to be very patient also means that you might incur opportunity cost at some point, which becomes sizable, right? So where do you draw the line between, okay, time wise, and then, yeah, as I said, sort of the switch in your strategy?
Yeah, so small companies can remain undervalued without a catalyst forever sometimes.
Yeah.
There's no real reason why investors should get excited about them. Um, but there's as I've been able to just process so many of these companies over and over and over again. Before as I was just getting into like looking into these small, tiny companies, I would, have like a group of 10 companies that I'd looked
Hmm.
into, and I would just pick what one I thought was the best. And over time, as that list grows and it's 25 companies, 50 companies, you just you pick your best companies. And now I have cheap companies, and when a catalyst does come along, I'm ready for it. It's not one of these things where I'm constantly turning over these new companies and I'm just finding oh cool, I just this just happens to be this perfect like
Yeah.
moment, that I'm stumbling upon. Sometimes it's that you sit on these undervalued companies for a year, 2 3 years, and all of a sudden you're like, oh, these guys just signed a large contract with a distributor, and it's going to double their revenues, so it's just time.
Yeah. Would you say that perhaps in the past few months, with the market evolving as it's been, and sort of from my experience looking through also, all of the SEDAR and Edgar databases, like I get the sort of sense that, at least from my personal view, the criteria that fit me, right? I'm not really more of a traditional value investor. I'd say I look at I try to look at things from all different perspectives. So I wouldn't say that I have a clear set 100% criteria. I'm more sort of flexible when it comes to that. But I get the sense that it's getting, at least for me, way harder to find what fits my criteria. Did you sort of have that experience in the last few weeks, perhaps because you're also in that sort of deep value space?
No, right now. So probably the last year or so, maybe. It was I thought a little bit harder to find some undervalued stocks occasionally, and right now, I think that it's a lot easier than it has been in a couple of years. One of those reasons is because people are worried about AI catalysts. That's kind of bringing some
Yeah,
valuations
the
down for
software
yeah, large
sell-off.
companies, and it's doing good for valuations on SaaS, but it's also making its way down to like these smaller companies that people don't really think of as like feeding into AI. Whether it's like these companies that make cooling technology,
Mhm,
coal companies that all of a sudden there's a lot more demand for coal. Those things have shot up, but sometimes some of these energy companies might take some L's temporarily while all of this new information about whether or not AI is going to be as productive as people say it's going to
mhm,
be, or what direction it's going to move, kind of gets digested in the market.
mhm. And looking at your experience over the past 2 years, like what is one stock where you were like, it is cheap, and you bought it, right? And that taught you sort of an expensive lesson about your approach.
Yeah. So I've said this on a couple of podcasts, but probably uh, uh, Rick's Entertainment. It's like they have three segments. They had a casino segment, a like
Hmm.
Hooters segment, and they were their biggest part of their business was a strip club chain. So the strip club chain, basically, nobody wants to own a strip club in the United States anymore because
Hmm.
local municipalities hate you. They don't they don't
Yeah.
want to issue permits for that. They there's not like if you own a bunch of strip clubs, you're not going to get a bunch of competition coming in because it's like an old sleazy 70s, 80s
Hmm.
thing to kind of business to run. The younger generation is not interested in doing that. And these establishments still generate a lot of cash flow. And that was happening. This company was the only company that was basically buying up these chains. But management thought that they were more competent in running other types of businesses than they really were, and they were trying to get into the casino business, and they were trying to
Yeah,
get
it's
into
essentially management hubris in a way.
yeah, they were trying to get into like these low margin food franchising businesses that just sucked. And yeah, I just the the catalyst to realizing value when I had originally invested in them was
Hmm.
extremely cheap, and every single quarter management somehow could not like hit any of their markers. They couldn't hit this turnaround, and the pathway to that turnaround seemed like it was very easy. Basically, they had to sell off a couple of business segments that weren't doing very well, and just kind of finish opening up a couple of
Hmm.
casinos, and they just bit the dirt. Another one was carparts.com. They had an enormous amount of inventory, enormous amount of traffic on their website.
Hmm.
I think they had the number one eBay store at the time, and they were an extremely cheaply priced stock, and they just couldn't hit a business turnaround. They were unwilling to sell off assets, and they just massively diluted their share count. And those are probably my two biggest L's that I, looking back, probably would have not invested in. At
Hmm.
least that were value investments.
Hmm. And I also assume, having had those lessons, you also, it's a continuous process, really investing and sort of improving. So I also assume that, having had this experience, you were like, okay, maybe it can happen to me that at one point I have another such opportunity, and management doesn't execute as they should, because there's always execution risk, right? That's non-negotiable. And but always with those parts, sort of the most important thing is really, how do you manage that position relative to your portfolio. And so, like, I assume sort of that these things also helps you to really get a feel at when probably it might now be a prudent thing to, let's say, sell that position, because it's been this and that sort of thing didn't happen as I originally thought in my thesis, right? And yeah, so how did that sort of go for you?
Yeah, my decision to sell is always when the reason I bought that stock ceases to exist. So in the Rick's case, they had to open up a couple of casinos that they were
Hmm.
dumping a bunch of capex into, and they had to potentially sell off or franchise out some of their underperforming restaurants. I forgot what the wings. It was a Hooters ripoff franchise. I forgot what it was called. It was like
Hmm.
Bombers or something. Um, and every single earnings call, if they were asked about those issues, they would just push back against it. So it became very clear and evident that my initial thesis behind that was not going to play out, and I got out of the position. At the time, I was down like 30%. I actually would have I probably would have broken even 6 months from that. The stock
Hmm.
did rebound before it tanked again, but I just my thesis was not there, and I found a another investment that I thought was a better opportunity. Same thing with the carparts.com. I stuck with it, and I would have sold off when management had announced that they had diluted, that they were going to dilute with a massive share issuance. But I actually got out of that position earlier than that because I
Mm.
just found a better position and I was short on cash. So I instead of taking a chance at management making the right decision or whatever on that company, I just dumped my money into somewhere else.
Mm. Yeah, I mean, for me, sort of just talking from my own personal experience. So 2025 for me was sort of the time where it was really okay. I found some cheap stocks, like for example, Zoom Technologies. It was fast growing. It had a nice nine price to earnings ratio. That was pretty cheap considering it was in the ad tech sector, right? And from my sort of experience with that one was, which is sort of adjacent to what you mentioned, right? So there was this big run up, right? It went up like 30%, but because of institutional discovery, right? I mean, you probably also notice in some of your stocks, right? And what happened to me is it just continued to slide down, right? Getting close to the quarterly revenues. Then the quarterly numbers came out. It sort of disappointed investors in a sense, and really at these sort of moments, you just have to sort of really take the loss, right? I mean, sometimes you really have to take the loss and say, "This is it. I can find something else," right? And this is sort of a thing that is at least in my sort of experience, a continuous sort of learning, perhaps also for you. And sort of to attach it to a question, like when you look at these stocks, right? If you had to choose a financial ratio that was interesting for you, like, and that you had to use for the rest of your life, let's say it's just an sort of a case, which one would it be?
It would probably be enterprise value.
Mm,
Enterprise value seems to be the most depend. I don't think any ratio is like this gold, besides maybe the golden ratio, but like I don't think there's any special ratio that
yeah.
that's gonna like completely work its magic. But I feel like when I find a company that has an extremely cheap enterprise value compared to their market cap, um, it's it's just an extremely good opportunity, especially for some of these cheaper companies, for them to make a large business turnaround. One thing, small enterprise value means that that company probably does not have any debt and
Mm,
or has a ton of cash. That's always a great thing. That's always something that if a company's going to get acquired or they're going to merge, like why wouldn't you want to buy a company with no debt and a ton of cash, especially if you can buy a company for essentially cheaper than it's trading at, with
mhm,
those cheap enterprise values. So that makes good merger and acquisition targets, and it also makes a cheap and compelling story for any of the smaller institutional investors or uh, yeah, anybody that's doing activist investing, because activist investors generally the market's already turned on that company. It's trading at dirt cheap valuations, and it's
mhm,
just begging for anybody that does have a little bit of capital to deploy to come in there, maybe take a board seat, try to turn things around, or like I said, a larger company to come out and just buy that company out flat right because it complements their business in some way.
mm. What is your sort of view on activist investing, right? I mean, we don't see it a lot really in the small cap space. So, what is sort of your view on that?
Uh, I mean, I'm for it. If you own X amount of a company, you should have a say in how it's ran. It's management hates it sometimes, but it
Yeah.
is what it is. Those are the rules, and it's my opinions on things like that. I feel like don't really matter. It's just what the law is and how you play that as an investor. So if things are I feel like activist investor targets for companies, sometimes I will invest in a company based off of that. Actually
Mm,
kind of what's going on between Ruger and Beretta right now is it's not really an activist investor situation as far as one activist investor goes, but
mhm,
Beretta just took out almost a 10% stake in Ruger and is talking about potentially trying to force board members onto the board. And I invested in Ruger largely based on that. Our overall firearm sentiment at the time I invested in Ruger was a play into that too. But when a company buys that much of another company and is going to do like basically have to delegate all of those resources to help running that
Mhm.
company, they're only doing it because they
They see
think that there's
value.
going to
They
be
see
enormous,
value in it.
yeah, there's an
Yeah.
enormous advantage to that. And so Beretta sees something there, and you know, that's one of the reasons I'm still in that position.
Mhm. So, and that's also leading right into my question, and that's like, what stocks do you find currently appealing, and maybe where you can also say, okay, I have a reasonable or rather higher amount of confidence that I would, at least want to have it long term. If it pans out, that's a different question, right?
Yeah. Well, they're actually larger cap companies, but
Mm,
I did just dump money into Adobe because I think that they're super cheap for how ahead of the game they are, I guess, with like their general AI. I think if any company's probably poised to do pretty decently off of that, it's a company like that. Again, larger companies that I'm invested in right now, Ruger and Smith and
mm,
Wesson. Guns, gun manufacturers were extremely cheap, especially after Trump got elected, because the general consensus is Republican administrations in the United States are bad for business when it comes to guns, and that's
mm,
not even necessarily true. Uh, Alico is a company I've held forever. They're an Orange Grove company in Florida, and basically oranges are going extinct because of citrus greening, and
yeah.
their orange groves are right around some of the fastest growing metropolitan areas in the United States, and converting that all that orange grove land into housing and commercial buildings is just going to be worth infinitely more than it would be as a simple agricultural land. Yeah, just plays like that. Just any time that I see
Mm,
these weird things, the market has to hate something that makes money and is probably not going to go away.
mm.
Companies
And
with, oh, go ahead.
I mean, you can finish your no trouble, but uh, I
Oh yeah,
mean,
it's just
okay, yeah,
companies with you know, the government can't print land, and companies with a
mm,
lot of land in very valuable, unique places are going to make a lot of money. That was true in the 30s. It was true during the Great Depression, and it's true now. Just like little things like that. There's only so many ways to run a business and so many ways to make money, and a lot of these old value investment styles are, in my opinion, are not outdated. You know.
mm. And I mean, you're not just value in that sense, but you also have to sort of think contrarian, right? In a lot of these instances, like, what gives you the confidence looking at such situations to not only think contrarian but also stay contrarian? Like, is it just the valuation perspective, or how do you sort of see that? And also, how did you get into that sort of part, really,
Well,
like the mindset?
yeah, when companies are cheap, it's because everybody dislikes them, and that's when the opportunity for you to invest in them happens. So I think value investing forces you to be contrarian, or if you're not contrarian,
Mm,
you probably are going to be a bad value investor. I've never been like the person that's been on the beat of what's most popular, what everybody's into. If there's like a fashion trend, I am sure to miss it. So Um,
yeah.
bothering to pay attention to what other people are into or care about has never been my thing, only because, I've just always been, like, a couple degrees off of cool, I guess, you know?
Mm.
So, that in this particular aspect of life, I feel like that has been very beneficial.
Mhm.
So,
Yeah, I
not
mean,
always, but here.
yeah. I mean, I also have that sort of perspective, every time when I see the stock market decline for whatever purpose it might be, that's really when times get interesting, because even in some of these stocks that are like traditionally growth stocks, you'd say, the sunny transition into sort of periods where you can consider them having, at least historically, uh, on that sort of perspective, a valuation that is at least, like suiting the sort of value investing strategy, right? So, I mean, you mentioned Adobe, right? I mean, a lot of people, or PayPal, I mean, those are two stocks that are very hated right now. So,
Yep.
a lot
I've
of
been
people
talking about
would
PayPal a
probably,
lot.
yeah.
Yeah.
I mean, I see always, on Twitter the last few days, I saw a lot of people commenting on that. So, it's really, it's also like, what did you like lead you into the path of becoming interested into them? Because like PayPal, even, yeah, it always had people that didn't like it, but you always had a lot of people saying that, it's undervalued, it is this, it is that. So what made you like recently sort of flip, also become sort of interested in those stocks?
Well, PayPal and Adobe, I mean, tech stocks have been at like 30 PEs, 20 PEs, whatever, forever.
Mm.
And I don't even think I'm logged into Seeking Alpha on here, on this computer. But PayPal was sitting at like a 6 PE, right? 7.3 PE right
Mm.
now. And Adobe was like at a 9 or something like that. That like never happens in tech stocks. PayPal has something super important, which is one, Venmo, which online banking businesses in the United States are not regulated like traditional banks are. So they have a lot more
Mm.
flexibility on what they can do. And I think that PayPal and Venmo are two online banking like scenarios that and software companies that people trust. So many people have these like weird checkouts nowadays on all these websites, and you go and you see like a no name checkout box and you put your
Mm.
credit card information in, and I mean I do it, but like I don't like to.
Yeah.
It makes me feel way better when there's a Venmo or
Yeah, or
PayPal
PayPal, yeah.
logo. That's I feel like that's a still has a lot of value to it. Um, I'm actually a musician. I play music. I've like filmed like music videos and done video editing and stuff like that.
And what kind of music, if I may ask? Like, that's
Uh,
really curious.
Death metal, like
Oh,
yep, old school
well,
death metal.
I'm a fan of Chuck Schumer. Chuck Schumer, yeah, it's from Death. So
Oh,
yeah,
Chuck
yeah,
Schuldiner. Yeah, I love
yeah.
Death.
Chuck
Yep,
Schuldiner. I always
yep,
mix
yep.
it up. Yeah,
Actually,
yeah, great
okay,
band.
so off topic a little bit, but I'm from right around Flint, Michigan. Two of the people that Chuck had in Death were from a band called Repulsion, and they're the
Yeah.
band that started Grindcore. But yeah, but
Mm.
learning
Yeah.
how to do all of that in this video editing, when I started off video editing, there was like there was all these other programs that people could also use. Uh, People only use Adobe Premiere now, pretty
Mm.
much. I don't really know anybody that uses Final Cut Pro anymore or anything. It's just like Adobe for creative platforms is it's not a monopoly, I guess, but it's pretty close. Like it's something that you have to use. It's way better than everything
Yeah.
else. And I think there's a lot of value in that.
And it's very sticky. I mean, even with the fees they do charge,
Yeah.
which is a substantial amount.
These companies have growing revenues too. Like people act like like these companies are in the middle of like a huge depression in earnings or something, and they're not.
Mm. Mm. And we're sort of nearing the end of this interview, and are there any sort of last things that you want to mention to the audience?
Well, if you do want to read anything that I have to write, go on Substack and I write a newsletter called The Value Road. I have little free sections, and if you want to become a paid subscriber, I'd love to have you. Other than that,
Read The Intelligent Investor.
yeah, read up on Benjamin Graham, read up on like I would say The Phoenix Approach is a great book to read.
Mhm.
Uh, you know, Bill Ackman made some great videos. Oh my God, what is that guy? Okay, yeah, duh. Controversial figure, right? Martin Scarelli.
Yeah.
he went to prison for jacking up the price of an AIDS medication like 1,000% or something.
Mm,
I don't have any opinions on that. Probably not great. I guess, probably not great to do. But
mm,
that guy made videos on how to do discounted cash flows that, like, when I was stuck on, that was one of the most difficult things to kind of like teach yourself, And when you're stuck on
mm,
something like that, like videos where he just sits down and for 4 hours to do discounted cash flows and just like talking, I just there it's a godsend. you know,
mm.
Check. There's
Yeah,
all of these small little resources online now that you can kind of piece together to really learn a whole lot. And don't get frustrated when you're learning something and it's not sticking, or when you're having problems with your investments initially. This stuff takes years to learn. Just
a
learn.
lot of patience
Yeah.
and the sort of, in economics they call it human capital, and that really compounds. Even like people really underestimate, it's not just your returns that will start at some point, but also the human capital you've built along it compounds and compounds
Oh yeah.
to the point where you really uh you had all these questions at the beginning. You still have a lot of questions, but at least the basics and all the nuances, you have way more of an idea as you did before. So
Yeah. I would say every single year that I invest, I try to be embarrassed about what I did not know the year prior to that.
mm,
And for me, what helped me become a much better investor than I would have otherwise was I started writing about my investment thesis. Like I had
mm,
to take that extra step between thinking about an idea here and writing that down on a piece of paper or on Microsoft Word, and kind of extrapolating all that data out onto
mm.
something that I could read back. That
Yeah.
did wonders.
Yeah, I can also recommend it to all the people out there. I mean, really, when I started writing up my thesis the last few days, like it sort of things, even just the little nudges, even just the little parts, like you just become so much more aware of them and put them into a much clearer context than whatever you had in your head reading and synthesizing and putting a conclusion together, right?
Yeah,
So.
organizing those ideas just it goes a long way.
Yeah, and really, I have to say thank you for having the opportunity to talk to you, and it was great. Also, getting sort of a view of a different perspective. I mean, you do have a sort of a really value type investor perspective that I do also share to some extent, but of course, everybody has their own sort of way at looking into stocks, and that's what makes the market's so unique, because it's so many differences of opinions, and at the end everybody sort of finds their own edge, their own strategy, you know
Right.
so
Yeah,
yeah, it
doing
was
that,
great.
in my opinion, just being a little bit different and finding your own niche. There's a million ways to be successful. You just have to find what your realm of confidence and competence is.
Mhm. Yeah, and again, thank you for the opportunity to talk with you, and yeah, maybe in a few weeks again, right? So
Yeah.
yeah.